everybody, so welcome to Learning Channel. Today we're going to be learning about intermediate accounting, and I'm gonna be recording myself to read the intermediate accounting book. It's a conceptual framework underlying financial accounting, and let's begin the audiobook. Enjoy. Basic principles of accounting. The first one is historical cost principle. We generally use four basic principles of accounting to record transactions: historical costs, revenue recognition, matching principles, and full disclosure. The first one is historical cost principle. GAAP requires that companies account for and report most assets and liabilities on the basis of acquisition price. This is often referred to as the historical cost principle. Cost has an important advantage over other valuations. It is reliable. To illustrate this advantage, consider the problems if companies select current selling price instead. Companies might have difficulty establishing a value for unsold items. Every member of the accounting department might value the assets differently. Further, how often would it be necessary to establish sales value? All companies close their accounts at least annually. Some compute their net income every month. These companies would have to place a sales value on every asset each time they wish to determine income. Critics raise similar objections against current cost, replacement cost, present value of future cash flows, and any other basis of valuation except historical cost. What about liabilities? Do companies account for them on a cost basis? Yes, they do. Companies issue liabilities such as bonds, notes, and accounts payable in exchange for assets or perhaps services for an agreed upon price. This price established by the exchange transaction is the cost of the liability. A company uses this amount to record the liability in the accounts and report it in financial statements. In general, users prefer historical cost because it provides them with a reliable benchmark for measuring historical trends. However, fair value information may be more useful for certain types of assets and liabilities, and in certain industries. For example, companies report many financial instruments, including derivatives, at fair value and inventories at lower of cost or market. Certain industries, such as brokerage houses and mutual funds, prepare their basic financial statements on a fair value basis. At initial acquisition, historical cost equals fair value. In subsequent periods, as market and economic conditions change, historical cost and fair value often diverge. As a result, a fair value measures or estimates often provide more relevant information about the expected future cash flows related to the asset or liability. For example, when long-lived assets decline in value, a fair value measure determines any impairment loss. The FASB now appears to support greater use of fair value measurements in the financial statements. The board believes that fair value information is more relevant to users than historical costs. Fair value measurement, it is argued, provides better insight into the value of a company's asset and liabilities or its financial position and provides a better basis for assessing future cash flow prospects. The FASB is developing a standard on fair value measurements, which provides guidance on how to measure fair value. This standard applies to both financial and non-financial assets that are measured at fair value. As a result, we should now have increased consistency and comparability when fair value measurements are used in the financial statements and related notes. Such consistency and comparability is very much needed in light of controversies using fair values at companies like Enron or valuation of energy contracts and JP Morgan or valuation of its bond portfolio. In addition, this new standard clarifies and incorporates the guidance in Concept Statement 7, using cash flow information and present value in accounting measurements. For using present value techniques to estimate future cash flows, and it provides enhanced disclosure of fair value information. As we indicated above, we presently have a mixed attribute system that permits the use of historical cost, fair value, and other valuation bases. Although the historical cost principle continues to be the primary basis for valuation, recording and reporting of fair value information is increasing. Okay, so the second basic principles of accounting is revenue recognition principle. A crucial question for many companies is when to recognize revenue. Revenue recognition generally occurs when realized or realizable, and when earned. This approach has often been referred to as the revenue recognition principle. A company realizes revenues when it exchanges products or goods or services, merchandise or other assets for cash or claims to cash. Revenues are realizable when assets received or held are readily convertible into cash or claims to cash. Assets are readily convertible when they are sellable or interchangeable in an active market at readily determinable prices without significant additional costs. In addition to the first task, realized or realizable, a company delays recognition of revenues until earned. Revenues are considered earned when the company substantially accomplishes what it must do to be entitled to the benefits represented by the revenues. Generally, an objective test such as a sale indicates the point that at which a company recognizes revenue. The sale provides an objective and verifiable measure of revenue, the sales price. Any basis for revenue recognition short of actual sale opens the door to wide variations in practice. Recognition at the time of sale provides a uniform and reasonable test. During production, a company can recognize revenue before it completes the job in certain long-term construction contracts. In this method, a company recognizes revenue periodically based on the percentage of the job it has completed. Although technically a transfer of ownership has not occurred, the earning process is considered substantially completed at various stages of construction. If it is not possible to obtain dependable estimates of cost and progress, then a company delays revenue recognition until it completes the job. At end of production, at times a company may recognize revenue after completion of the production cycle but before the sale takes place. This occurs if products or other assets are sellable in an active market at readily determinable prices without significant additional costs. An example is the mining of certain minerals. Once a company mines the mineral, a ready market at a quoted price exists. The same holds true for some agricultural products. Okay, let's take a look on another case. The case is upon receipt of cash. Receipt of cash is another basis for revenue recognition. Companies use the cash basis approach only when collection is uncertain at the time of sale. One form of the cash basis is the installment sales method. Here, a company requires payment in periodic installments over a long period of time. Its most common use is in retail, such as for farm and home equipment and furnishings. Companies frequently justify the installment sales method based on the high risk of not collecting an account receivable. In some instances, this reasoning may be valid. Generally, though, if a sale has been completed, the company should recognize the sale. If bad debts are expected, the company should record them as separate estimates. To summarize, a company records revenue in the period when realized or realizable and when earned. Normally, this is the date of sale, but circumstances may dictate application of the percentage of completion approach, the end of production approach, or the receipt of cash approach. Okay, so we're going to be continuing this video on the next video, and I hope to see you all again very soon. And see you. Bye. Thanks. Have a great day.